Hello, everyone. Welcome to Wall Street for Main Street podcast. My name is Mo Dawood, and today's guest is a guest that expertise is focused mainly on China and what's going on there. Today we have Dan Joseph. He's the editor of the China Learning Curve, and he's also an author. Dan, thank you for joining us.
Thanks for having me, Mo.
So I want to start off this podcast by talking about your background. So why did you decide to live in China and do business there? I know you told me before the podcast that you lived in China for about over a decade.
Yes. Well, I mean, I don't know, sometimes it's hard to exactly explain why we do things when we're young. I'm a graduate of Georgetown University School of Foreign Service. I was always kind of into, international issues, and I had a thirst for that type of experience. When I got out of college, I spent a couple of years in New York in the banking and finance field, and I wanted to do something a little more globally oriented. Ended up with a job in Taiwan for a couple of years doing some project finance work, and I started studying the language, and I was learning about the culture, and it was all very interesting to me. So one thing led to another, and before I knew it, I had a job on mainland China, and so China kind of became my expertise. I end up with kind of a mixed background, kind of half finance and banking type of stuff, capital markets. And I've also done a lot of management on the industrial side too, but most of it focused on China over the last 20, 25 years.
So what made you decide to do business in China over, any other countries around the world?
Interesting. I mean, for me personally, way back when I made that first move to Taiwan, they were deregulating their financial sector, and I was a finance guy, so I was able to get a good job, and they had easy work visa regulations, so it all worked out. And then, as luck would have it, Taiwan has that connection to China, same language, culture, etc. Although there's the political problem between the two, so you kind of look over the strait there and think, gee, there's a lot of opportunity on the other side of that. So my next move was to mainland China, and I started in mainland China back in the 90s, so this goes back a ways. And fortunately for me, unlike some of the other developed countries, for example, some of the other BRICS, China's growth has been more continuous and sustained. So it's turned out to be kind of the right choice. So as my career continued to progress and China continued to grow, it's an interesting place to be. There's lots of opportunity. Obviously, there's lots of challenges as well, but it just became a good place to find opportunity and to develop expertise. And hopefully it'll continue to grow like that and continue and remain a place that's full of opportunity.
Yeah, and I think one of the misconceptions about China is for a foreigner someone coming from the outside going to China, it's not very hard to set up a business in China.
Yeah, well, I mean, it's funny. China is, it's becoming, probably the thing that many people who don't have the opportunity to study China closely, that they don't perhaps understand is that what China is doing is kind of a gradual step-by-step transition from a communist centrally planned economy to more of a free market oriented economy. And so at this point, 35 years ago when the reforms began, the government controlled basically 100% of the economy. Now, 50 to 55% of the economy comes from the private sector. That's entrepreneurial companies, privately invested companies, foreign invested companies. And that's the part of the economy that's generating job growth and better quality and better technology. That's the dynamic part of the economy. The other part of the economy is still dominated by the state-owned companies. They're, more heavily regulated. So it's a mixed economy right now, but it's always important to remember what direction it has been moving in and hopefully will continue to move in, which is toward the free market. And that tends to impact just about everything. So, for example, your question was about setting up a company in China. The interesting thing, particularly when you're in emerging markets, is this is true anywhere, but particularly in emerging markets where the rule of law is sometimes a little fuzzy. Sometimes you don't necessarily go by the rules. When you're going into a country like China, I want to recommend that everybody play by the rules. But just to give you an example, China's procedures for actually setting up a company have always been kind of onerous and very administratively heavy in terms of the burden. However, there was also a period where you could go over there, I did this years ago, open up a company. We operated for more than 6 months without a license. we weren't a big company. We hired, maybe 5 or 10 people. And as long as you kept your books so that when you finally got your license, you could go to the tax authorities and say, oh, by the way, here's everything we've done. You pay your taxes. Everybody was happy. So you could, even though the process was a bit cumbersome, it didn't slow you down that much. Now, what China is doing is making that gradually, step by step, making that process of incorporating easier and easier and easier. There's less requirements to put capital in. It's easier to get approval. It's still not nearly as easy as places like the United States or even Hong Kong, but it's moving in the right direction. The good news is, because the opportunity in China tends to be significant, it's usually worth the effort to set up the company.
Right, because when I was looking into China, one of the things that I found out that if you're an entrepreneur and you set up shop in China, the first 5 years in business, I believe, they won't tax your income. I don't know if that's still true or not. Maybe you could comment on that. But I was surprised on how little business friendly they are when the image that everybody has about China is that they're very unfriendly when it comes to business.
Yeah, you know what? I mean, China has almost a constantly evolving, like our other economies, set of incentives that are geared to drive certain sectors of business. Recently, China has enacted a number of tax relief measures for small businesses. They have some new free trade zones that make it easier to incorporate and get into other types of businesses. So, yeah, I mean, China is doing what it can to help small businesses, Chinese and otherwise, to encourage foreign investment. I mean, depending on what sector you're in, you really have to look at the regulations almost on a sector by sector basis. But yeah, I mean, China it doesn't seem like it because it doesn't get a lot of the media coverage. That's what's interesting about this mixed model that they have. Part of the economy is extremely entrepreneurial and extremely dynamic, and then there's yet another part of the economy that's more lethargic and state controlled and heavily regulated. So it really depends on what sector you're in. But for a lot of it tends to break down about as to whether you're in a new or an old industry. Old industries like maybe energy or heavy equipment, and even sensitive industries like media or banking. Those are more highly regulated. But if you're in light manufacturing, technology, services, business services, retail, that stuff is all more dynamic, entrepreneurial. Sure, some aspects of incorporating and other things are a little bit more bureaucratic than they would be here, but you'll find that it's a very competitive, dynamic playing field once you get there.
Yep, and that's a great point. And one of the things that's very attractive about China compared to the U.S. is that growing and very strong middle class. Their wages are going up, and they're starting to spend more and starting to have more discretionary income. So for people in the retail area, going to China makes a lot of sense.
Yeah, absolutely. I mean, the retail sector has been the strongest sector in China the last couple of years. I mean, basically, your listeners may hear a lot of negative economic news coming out of China. There's some truth to that. The Chinese, after the financial crisis in 2008, they were at the time of the crisis in a pretty good position with debt to total GDP of about 120%. That compares to more than 300% for the United States and most of the developed world. But then what China did is they leaned heavily on credit creation to kind of fuel growth, pushing money into real estate and infrastructure spending and that sort of thing. So now, 7-8 years later, they're looking at a debt to GDP ratio. People estimate somewhere between 230 and 280%. It's still not in the red line area yet, but it's getting close. And the rate of growth in the credit creation and fueling economic growth through debt is just too high. So hopefully they'll back off of that, and they seem to be, but, the proof is in the pudding. We'll have to wait and see. And they won't create a balance sheet problem that is going to really impact their growth over the long term. In the meanwhile, because of all this, sectors like real estate and infrastructure have softened a bit, which has brought their economic growth down. But the strongest part of the economy that's still fueling growth is what you just said, is the retail side. So although economic growth is down in the 6 to 6.5% range, retail growth continues to be more like 10% or more. And that's because there's a high savings rate in China, and that middle class is growing, has incomes have increased, and that is continuing to fuel growth in China. If they can just prevent themselves from having an oversized balance sheet problem, if they don't get too over leveraged and they continue to liberalize that economy, then that trend of increased consumer spending as their middle class grows should continue as well.
Yeah, I know there's a lot of retailers here in the U.S. that would die for 10% growth right now because they're struggling a lot to maintain sales. So if you don't mind me asking, what type of business did you have in China?
Well, I mean, I myself was in earlier positions. I was in mostly the industrial space. So, worked for managed an operation that sold coal mining equipment and also industrial parts and things like that. For the last 5 or 6 years, I've been on the consulting side, advising foreign companies that are doing business in China, and that has ranged everything from industrial to retail and service and other types of companies.
Okay, interesting. So let's talk about the economy in China. I know we talked about some of the misconception about the economy there. What do you think is the biggest misconception about the Chinese economy? I see a lot of stories about the ghost town that they built, even though that's pretty misleading after interviewing a few other people that live in China. So I want to get your intake on that.
Yeah, I just think that, what I like to tell people is, I think, and your listeners, because they're interested in economics and finance, might kind of get this, but it was only 7-8 years ago that we frankly imploded our own economy. And we created a big crisis. And as I always like to say, if you ask 10 economists their opinion as to what we should do now, you'll get 10 different answers. So clearly, we haven't mastered our own economy completely. And then you throw in, you have the economy of an emerging market, a developing country. We're not as good at assessing those economies. Sometimes we think they're going to, that India or Brazil or some other country might be on the right track. Then it turns out they're not. And then you throw in the fact that China is transitioning from communism to more free market-oriented economy. So you lay all these factors on, and it's no wonder there's a bit of confusion as to how you interpret the Chinese economy. And the big problem is, because they're making this transition and they're kind of halfway across the river, if you will, people can build arguments in any direction saying that the economy's, more free market oriented than it actually is, or maybe more state dominated than it actually is. And a lot of people overlook the factor that the most important part in the Chinese economy is that they're moving in that direction toward the free market, and that's what's driving growth. So the biggest misconception is just how free market oriented is China, how, quote, communist is it still, and understanding that it is moving towards the free market, and that movement is driving growth in China. Now, the point that you made relative to the ghost towns, that's another challenge in China because it's so big that it's easy to get lost just looking at a more narrow view. So on the one hand, yes, there's been a lot of overbuilding, and that's not good for the Chinese economy. I don't think anyone would deny that. However, it's like a company. You can borrow money that you might have for a project that might not be successful. But as to whether or not it's going to ruin your company, it depends on how much you borrow. So people were predicting 15 years ago that China's banking system was so overwrought with bad debt that the economy would collapse. What they didn't consider is that while that might be true, for the country, their bad debt or their debt to GDP ratio was still extremely low. The banks were mostly controlled by the state. So for the state to recapitalize the banks was like the United States government, if it didn't have a balance sheet problem, giving money to one of the states. It just wasn't a big deal. So you really have to look at the big picture, which is what I alluded to earlier. Ghost towns are a problem, but not if your overall debt ratio, debt to GDP, let's say, is still reasonable. China's problem is it's now built that debt to GDP ratio up probably above 250%. Once you start to get to 300%, I think you can really start to impact growth as it is here in the United States now. So the ghost towns aren't a huge problem. They'll grow into those. The problem is if they keep piling on the debt, then they're going to have more and more ghost towns, and eventually it's going to be too much, and it's going to slow that economy down.
Right. The guest that I interviewed in the past regarding the ghost town is that there's a building, it's empty, but after a year or so, it's filled up. So we're getting this narrow perspective on the ghost town in China, but it happens here too. When they build a condo, it doesn't fill up right away. It's empty for maybe a year or so. But in China, they built a new city and it's pretty empty. But after a year or so, it's filled up. But yeah, I agree with you. They have the debt to GDP in China is it's starting to blow up. So there's a big concern there.
Yeah, I mean, there's no doubt that again, China. Another important statistic on China: roughly 45 to 50% of Chinese people still live as subsistence farmers, as peasants, if you will. They live as people who work farms, without tractors, not highly automated. So only 55% of the people have kind of joined the Industrial Revolution. So, and obviously some of those people are still on the lower side. So China still has a lot of way to go for everyone to afford a home. So they're going to need a lot of homes over the long term. There's no doubt about that. That's the benefit of being a developing country. They can grow into overbuilding better than we can. Still, we built too many houses in the 2000s, and we're still dealing with that. And like I said, as long as they don't, if they jack that debt to GDP up even higher, then they're going to have a problem. But if they maintain that at a reasonable level, the ghost towns will fill up eventually.
So let's talk about the debt problem in China. Do you think they're over-leveraged right now? That could be a cause of concern for the economy in China? Or another way, just a straw that could break the camel's back?
Yeah, that's the number one issue to watch right now, is where does that debt level go? They've just, to be perfect, 35 years of extremely impressive growth, outperforming every other emerging market over that period, including ones that are frequently mentioned like the other BRIC countries, Russia, India, Brazil. It's an impressive track record, and you got to give China credit. I think their approach to gradual transition to the free market and their ability to attract foreign investment has really worked. However, they've made some mistakes along the way, none bigger than what they've done since 2008. Leaning heavily on debt. They were in a good position. They could have kind of let the economy level off, let growth return to a more, normalized rate, not spent all that money, credit creation, trying to drive growth above 8% when frankly it didn't have to be if it's artificial growth. And so they've like everybody, to give them credit, they're certainly not the only country to rack up too much debt. We've done the same thing. It's just that what's disappointing is they had the opportunity to watch us do it, and then they did it anyway. You would have wished they would have avoided that. So I definitely think right now, with best estimates as the total debt to GDP being, like I said, I've read everywhere from 230 to 280, so I would side with at least north of 250. It's not crisis time. There are those that want to predict a crash. I don't think there's any reason that there will be a crash. However, a crash isn't your only problem. You keep piling on that debt, eventually it's going to slow your growth down. I would be among many who would say that's the problem we have here in the United States. We're going to have lower growth rates going forward until we solve this debt problem. And if China keeps piling it on, they're going to do the same thing to their economy.
Yeah, in this country we have a big debt problem, but the debt hasn't given us the output like it has for China. And so I think China has the tools to weather the storm better than the U.S., mainly because the economic foundation in that country is a lot stronger than here in the U.S., where China had a stronger middle class, a lot of quality jobs, and a lot of savings. And here, it's the exact opposite. We have a lot of problems. I don't think we can weather another crash like China can.
Well, I would put it slightly differently. What I would say is we're simply at different stages. And China is on a course that is appropriate for their stage of development. Basically, what got them from abject poverty to where they are now is, as I've said, this gradual liberalization, more and more free market industries, companies, entrepreneurship, better education, better technology. They're following a logical path, and for them, they don't have to become, the science and technology leaders overnight to succeed. They simply need to continue to progress, more and more liberalization, improving gradually as they have been, and they can stay on the same path, and I think they'll do fine. There's no guarantee they will. They need to make some smart decisions relative to their economic liberalization program over the next couple of years because it's slowed down a little bit. But as long as they do that, they do have that engine, as you put it, that foundation that will drive growth, that will allow them to outgrow the debt problem they have now, as long as they don't make it too serious. What I would say about the United States is I'm not sure we have put in place any of the measures to drive growth particularly well with or without the debt level we have. So it's harder when you're a more advanced economy, which we are, and China's just got more momentum than we do.
So let's talk about the Chinese currency, the Yuan. It has hit a 6-year low against the U.S. dollar, and I'm seeing a lot of the money go into gold and Bitcoin, surprisingly. So do you think the Chinese central bank is trying to devalue the Yuan to enhance the export markets, or is there another reason for this decline?
Well, again, it's important. Let's put it in perspective before we try to read the mind of the Chinese central bank. I think it's an indication as to the state of the global economy that the United States economy is, frankly, not terribly strong by historical methods, by historical measures and comparisons, and yet our currency is the strongest in the world because we look good compared to our major trading partners like Europe and Japan. So if you look over the last 2 years, Europe and Japan and most other currencies have depreciated against the U.S. dollar somewhere between 10 and 20%, most of them in the double digits, some more. The euro is more like 20%. China kind of held the line for a while, and then last August, almost a year ago, they permitted their currency to devalue by 2%, and now it's since then a total of 6%. So compared to other countries, they've actually held the line. It's not a radical devaluation. It's also important to understand China's currency pretty much rose consistently by a cumulative amount of 30% from about 2006 to about 2014 or so. Then, as China's economy started to struggle, as very often happens in any economy, when the economy slows down, people pull capital out of the economy. So the pressure on the Chinese currency has actually been going down. So the Chinese central bank has been supporting it, not pushing it down, but supporting it. And even the depreciation that's happened over the last 9 months is not a result of China forcing the currency down, but rather a result of China letting the market take it down a little bit. So is it currency manipulation? The only thing they're manipulating, frankly, is keeping it higher, not driving it lower. Now, the judgment that the Chinese central bank has to make is this. On the one hand, there's the theory that if their currency is lower, their exports will be higher, although some, and I would be one of them, to say because of the weakness in the global economy, there's only so much of a impetus they're going to get from lowering their currency in terms of driving exports. But they could do that. On the other hand, one of the reasons they've been supporting their currency is because a falling currency leads to capital outflows, and China has had huge capital outflows over the last year. And if they keep letting the currency fall, people are going to continue to take their money from China. So they've been trying to balance that. And it's hard to say if they decided to favor one in front of the other. I still think they don't want the currency to go down too precipitously, but it costs them money to continue to support the currency because they have to use their foreign exchange reserves to go in there and buy the RMB to support it when they have to. So they might, the support might only last for so long. So I wouldn't be surprised if it depreciated a bit further, but it's hard to guess at this point. There's people with opinions on both sides.
Yeah, there's a lot of hedge funds that were betting on the yuan to collapse. Even though it depreciated a little bit, it's holding its own compared to other currencies. Even though it's a fiat currency, and all fiat currencies eventually become zero over the long term. But it has evolved over the past few years. They've become part of the world reserve currency, and they also have been buying a lot of gold. And a lot of people are speculating that they could start a gold standard in China. I don't think that would happen, but we'll see.
Yeah, I think the good news about China's currency is that they would like to get it become more mainstream. See, one of the reasons they're liberalizing their currency, making it more freely traded, is after the financial crisis, they realized that America had piled up all this debt, and they were the ones who lent us the money, and that didn't make much financial sense. And if they basically they sell things to us, they export, we pay the money, and they lend it back to us. Well, that can't go on forever. So China realized the only way to decrease its credit risk, if you will, is to let foreign countries hold their currency. So now Chinese currency used to be, before 2008, you couldn't hold the RMB, the Chinese currency, outside of China. Now you can. Not broadly yet, but increasingly you're allowed to do that. So that's good because it makes China more integrated into the global economy. It also encourages China to make its currency more and more free market oriented, because if your currency isn't freely tradable, central banks in other countries and financial institutions won't hold much of your currency. So it's pushing China in the direction of a more free market oriented currency, and that's good for China and good for the world. It will take them many decades to actually become a substantial reserve currency. They won't be a substantial reserve currency probably for at least 20 years, but they're moving in that direction.
Right. So let's talk about the industry operating in China. What industry has been thriving lately in China? It seemed like the robotic and automation industry is heating up in China. I know Foxconn, which makes the iPhones and all the other Apple products, is starting to implement robotics and automation into their manufacturing plants.
Yeah, automation has received a lot of attention because China, for a number of reasons, but they placed a bid on their Chinese companies buying a major, put a bid in to buy a major robotics manufacturer in Germany. And of course, once you start digging into this, you realize that China is actually already the largest market in the world for robots, for manufacturing related robotic equipment, which surprises people since it's also a low cost country that makes sneakers and that sort of thing. But yeah, China, the way their economy is positioned right now, because of the kind of distorted investment program that I described, particularly since 2008, a lot of the heavy industry and the industrial side, frankly, there's just overcapacity, too many steel mills, too many aluminum mills. There's just overcapacity in a lot of industry. In fact, there's even too many automobile plants, although the foreign automakers are still doing pretty well. So heavy industry is kind of dragging. That doesn't mean it's dead forever in China, but they're struggling a little bit. Anything that is a little bit more consumer or technology oriented, frankly, is for the most part still doing well. I said, technology, higher end manufacturing, retail, services, certainly the IT sector, the venture capital space has been very active in China and the last 5 years, and the online business, e-commerce is, China makes, I'm not sure the exact numbers, but, China, developing countries sometimes skip a few steps. So as opposed to just online purchases, China's mobile purchasing via, smartphone applications is as a percentage of their total retail sales, at least 2 or 3 times what ours is. So they're digitizing a lot faster than we did. So a lot of those sectors are still doing very well in China, even though overall economic growth has slowed a little bit.
Yeah, and the wages in China have continued to grow double digits, so I'm not surprised that they're trying to implement robotic and automation into the manufacturing industry.
Yeah, right. Wages are, basically, give or take, the last 5 or 6 years, it's been fairly consistent. High single-digit or double-digit wage growth, particularly along the East Coast in China. You've seen a lot of, frankly, in China, I always make this point when I'm talking to people about, our trade relationship with China. If China were so skilled at manipulating trade, then why have they had to close so many plants and lay off so many workers themselves? Because, in fact, that's what happened, particularly in low value-added sectors like garments and tennis shoes and things like that. Toys, China's actually lost market share. So their wages, particularly on the East Coast, have risen dramatically. And so they're trying to transition into more higher value-added manufacturing. And lower value-added manufacturing is either moving inland to China, some of it, or out of the country to places like Vietnam.
Right. So I've noticed that China is trying to become more of a consumption economy rather than just a manufacturing, a production economy, much like the U.S. Do you think that's a good thing or a bad thing?
Well, I would characterize it as a good thing, but most importantly, I would simply say that it's a natural thing. I mean, that's the direction that any economy is going to go in. That's the point, ultimately, is to make people's lives easier by giving them, nicer and nicer things to be able to acquire. And China was, by definition, going to get there eventually. Now, because, again, this would happen with any developing country, it's going to make that transition to the point where consumer spending is going to take off. However, in China's case, because of the role that the government does play, there were certain programs, if you will, and investment programs and incentives that perhaps they would have done it better. It would have been better for them to start changing those 5 years earlier than they did. So from the outside, you say, well, they're making this transition largely because the government is changing the structure of the economy. Well, no, the government, in my opinion, is simply catching up to the direction that the economy had to go in forever. I mean, you can't just export tennis shoes forever. Like you said, wages have been increasing. That's a natural result of increasing prosperity, so you have to move into higher-end products. So most of what's happening in China is natural. The government just has to remove some of the impediments that allocate capital more efficiently to allow that process to happen more smoothly. And I think they're doing that. And I think ultimately, like I said, unless they let this debt problem get out of hand, they'll make that transition successfully. But, it takes time. Their middle class is growing, but keep in mind, China's per capita GDP is still less than 1/4 of ours. When other developing countries like Taiwan or South Korea were at this stage of development, they didn't, they weren't in the news all the time because, they don't have 1.35 billion people. China's still relatively early in its development process. They've made wonderful progress, but we talk about them because they're so huge that even though they're still not even a middle-income country, they have a huge footprint in the world.
Well, this was a great discussion on China, and we always try to bring guests to talk about China that actually live in China and have done business in China, rather than what, mainstream media, they try to get people to talk about China. They bring people on that only, visited China or have never been there, and they tell us that, China is collapsing, their growth's going to end, they won't be the number one economic superpower for long, blah, blah, blah. So we always try to get people like you to come on, and we appreciate it.
Well, I always say if you want to get to know China, you're going to have to leave that hotel lobby in Shanghai and really get out there and see it.
Right, good point. So if people want to find out more about your work, where can they go?
The website is ChinaLearningCurve.com.
All right, great. Well, thank you for your time, and hopefully you can come back on again soon.
Thanks for having me, Mo. Enjoyed it.